Good weekend morning, peoples. Let me jump in here with you. This is Bruce with Targeted Wealth Creation, and I'm going to go over October and the stock market and some of the things that I'm seeing. So I'll do my best to keep this fairly brief this go around, but I want to start updating this like once a week. What I'm seeing, is it following the trends? And I've got some sectors that I think are going to outperform. And I'll be telling you what I'm looking to buy and what levels I'm looking for. But honestly, this next 30 days is going to be critical in terms of directional moves. So let's jump in here. So we all know the Fed met and cut rates. So most of my analysis is based on that. So what happens historically, not just historically, but historically when the phenomena of September 18th, 2024 match in some ways, right? Not just any rate cut. Okay, so rate cuts, and let's read this. So using the same time frame, I overlaid the following past rate cut cycles: 81, 90, 2000, and 2007. Okay. These four cutting cycles, rate cut cycles, match the same data that we're seeing currently. Unemployment rate curving up, 10-year, 2-year inversion. The sentiment from the bulls is that rate cuts are suitable for the market. This is true in the long run. History shows that the market pumps on average for 25 days after rate cuts, followed by an average of a 13-month sell-off. Could we get one last pump around the cuts? Will this time be different? Well, let's dive into that. And anyone who tells you what exactly will happen is lying. So I include myself. I'm no different than anyone else. I'm giving you what I consider probabilities. I had one guy that I hadn't had to ban anybody or block anybody from my channel, but I had somebody basically call me bad names and say bad things when I just mentioned it, that I saw the markets going down. But again, a lot of times people take this out of context. They don't have a lot of personal knowledge. They fear something I say. They take the 50% retracement over 13 months as a worst case scenario and project that I'm saying in October the markets are going to drop 50%. I mean, could they? Sure. Is that less than 1% chance? Absolutely. And that's not what I said. Again, it was taken out of context. So I'm starting to feel like Trump. Um, the media. So, anyway, this is several scenarios mapped out over a late rate cut, which this clearly is. Okay. So what's an upside? Well, an upside spells out to about 7%. What's the downside? Somewhere around 50% over the 13 months in similar situation. Now, does that mean that's going to happen? Of course not, right? So let's go back up here, and I dove into some other charts and some other info that I gathered from some people I respect. So let's see, the SPX, the S&P 500, closed at 5618 at the end of trading on the 18th of September, which was FOMC announcement day. I almost said Greenspan. I'm dating myself a little bit. When Powell announced the 50 basis points rate cut. So the SPX closed at 5618. We're now September 27th and we're at 5738. So we're up 2.14%. And I was kind of saying, hey, history says we could jump up as much as 7% over the 25 days afterwards. Well, I'm fine tuning it a little bit. I don't know if we get there. I'm seeing some data now that indicates to me September 30th, Monday, could be a topping day. Now, we may go to higher levels interday that we close on September 30th. But I have a feeling that for the indexes, the S&P 500, again, a guess, guys, that September 30th could be a new high, right? In other words, it closes higher in 57.38. And over the next couple of weeks, which draws us into that final time before we start down, we could not have a close higher than September 30th. Again, we could also. I'm just throwing something out speculatively. And that's what markets do. They don't just all of a sudden go down, because once they go down, they're going to start moving fairly aggressively. So, what I'm looking for, and it's also possible we go to 6,000. But here's a couple other scenarios, people. We could, let's take my scenario. Let's say September has a 5800 number on it, right? Let's say that the market, I don't know what's realistic in a day, but let's say September 30th closes higher and it's up 2% more, and whatever that number is, right? That number then would probably be 58 something. And let's say that that's a high close, but we have enter days in October, the 1st or the 2nd or the 3rd, and we go up to 5850 or 5900, but we close below September 30 high. Anything is possible, okay? We could turn down 2, 3, 4, the latter part of October and into middle of, early part of election, and then get an outcome on the election and turn around and go up to 6,000 and then go into a subsequent retracement of these 27 or 45% over this 13-month window from the 18th of September, which would put us out into October, okay, of 2025. So you got all kinds of scenarios. One thing I've learned, and take this, right? This goes back to this statement. Anybody tells you that they just got it dialed in, they use Fibonacci, they use something else, and here's exactly what the market's going to do. That's less than 0.1% that anybody could ever be right. Okay. I could pick a date and say, the SPX is going to be 5,400 November 9th, and I could be correct, but it's much harder to say exact numbers throughout periods, right? It's kind of like, a stopwatch is time correct twice a day. That's the old joke. So let's keep moving through. Here's some other work, okay, that I found from a cycle person that I follow without giving names away here. And then I have more data. So how can one take advantage of the S&P bear? Well, there's a 3X fund out there, SPXS, right? So you want to catch that as low as you can catch it. Right now it's 669 because the S&P is close to a high. So if we run up and we were to run to 6,000 in the next week or two, that'd probably be a great buy. I don't know how to, correlate the number, but my guess this would be $4 or $5. It's kind of like my UVIX. I own UVIX in the fours. I own some in the low fives, and I plan on, because I see the weeks of September 30th, that entire week, and the week of September 7 in the markets, I expect the VIX to go up, even if the markets don't go down aggressively yet. So I've mentioned that in several of my videos. It's such a cheap stock right now in the fours, UVIX. It's basically a 2x inverse of the VIX. So if the VIX spikes, then UVIX is going to go up, right? It's been going down because the S&P 500 is doing real well. Well, what causes the market, what causes the VIX to go up? Volatility in the market. If the markets sell off or there's fear or there's news or stuff, overnight the VIX can soar and then the market starts to go down. So September 26, 2024. It has been 1 week, okay, but now fast forward, we're 3 days beyond that, right? Well, the weekend and 2 trading days. So a week past it. So in 2007 and 2001, kind of fits with the other stuff that I worked up. The stock markets reached their highest points 3 to 4 weeks after the Fed's rate cut, which is what I've been saying to you. A key indicator of the downward trend reversal was a close below the 10-day EMA, exponential moving average. It's currently, okay, at 5687 in the S&P. So what we're saying is this rate decrease in 1998 is not very relative to the current 2001 and 2007. So I'm going to ignore it because it didn't really go down with a rate cut. The S&P 500 over the next 9, 10, 11 months going into 2009 and the whole dot-com boom, right? So it doesn't fit. But these other two fit very well, 2001 and 2007. So I'm going to dive into those. But let's look for this 10-day EMA to be crossed under, this 5637. That still plays whether we go up to 58 or 59 or what we do. Once we start going below this, then that should be an indication we're headed down. And again, October's had some of the worst market crashes we've had. Do I know that there'll be a market crash in October? Absolutely not. But I'm going to play probabilities, right? I'm out of all my yield max income funds. Why the heck do I want to be in an income fund when I'm not bullish in the underlying market? I know you guys love it and you love margin and all that stuff, but God bless you. Good luck. I just think this is not a time to be playing around with income funds. I want to be in something long or short based on where I see the markets going. Right now, I don't care about income. I want to get quick trades. I want to get 2, 3 week swing trades, large percentage gains. Okay. Like my VIX, I hope I can get $15 on a mid to high fours and some other purchases in the low fives on my VIX. If I can get $10, I'm happy because I double my money. If I get 15, I'm super happy. If I can catch a little bit at 20 on a quadruple, I'm ecstatic, right? So, I mean, I've done this income game. I'm just not happy with it anymore. Now, I'll say to you, the only fund I'm going to miss, I got out of profitable in all of them, and mainly because of the income, right? My Misties and Conies, and the only one I didn't really make any money on was Ybit. But even my small amount of Ulti, my small amount of GDXY and stuff, I made a little bit of money. But on my Misty, I made a lot of money, and I made more like a little bit of money on my Coney. I am still very, very bullish on BTC going forward. Okay. And I'm not bullish on too much. I'm bullish on commodities. I'll talk about that. So, but there is a time to be in BTC and there's a time not. Now, we're moving up. If the markets turn down and the 30th and this next week is kind of the peak, near term peak in the markets, then Bitcoin has not been trading like a digital gold. It's been trading like a NASDAQ stock. It's been trading like the stock market. And until I see it behave differently, I don't want to own it. Okay. So if I see it rolling over in the market, then I'm going to go out and buy some pro shares short BTC. Okay. So my method is to use ETFs that are short with leverage or long with leverage, whichever way I want to move. And those ETFs, when you get a double or a triple, it's not something you want to be in other than a swing trade. I mean, 3 days, 5 days, 10 days, maybe a month. And that's a long time so there's some MSTX, or sorry, there's some MSTR. Defiance has got one that's 1.75. You guys asked me about. If you're bullish and you see it going, then jump in at, ride it, and take your money and get out. Okay, so let's go into 2007. Let's start with this one. So what did we do here? Well, let me show you the diagram, how to interpret it. So the red line signals the rate cut. So back in 2007, similar time frame, right? September, there was a rate cut. You see it here, and it continued to cut. And this did its little initial move up, right? Over the next 3 to 4 weeks. That's how I got the average. Okay. And then what did it do? Okay. Over the next 12 months. Well, I figured that based on these, the low was 45% drop. So it went from 1520, okay, at the time of the cut, and moved on up some, probably the 4, 5, 6, 7% gradual move up over the 20 to 25 days, and then it started trending down, right? And one of the key things, what are they showing you? Crossing below the 10-day EMA, exponential moving average. And you see this down here. So this is a pretty ugly drop, the 2007. All right, well, let's go look at the 2001. Similar setup to today's action. So what did it do? Well, it had a milder 27% retrace, right? Here's the rate cut. Here's the 25 days, right? And then what did it do? It turned down on the 10-day EMA. And look at this bottom down here. I measured 960 from 12. It's only at 27%. But guys, I know many of you in these income funds that are using margin, you can't sustain a 27% drop in indexes. Okay. And I got guys even in XDTE and QDTE. Guys, if the market were to drop, now granted it's over time, you can't make up that kind of stuff with just income. Now, if you've got an 8 to 10-year horizon, I'll get into those stats for you in a minute. I have a lot. I don't want to leave you in a vacuum and be the guy that's just coming out and saying the sky's falling in October and leave you hanging, right? I try to differentiate my recommendations to different kinds of investors. If you've got 10, 20 years of investing in the market, just keep doing what you're doing. If you've got a portion in income funds, keep DCAing in. It's no problem, right? If you got a long-term horizon. But I'm talking about somebody that's maybe retired, they're managing 2 or 300,000 and they're going, "Oh, I want to get in the 10K club, or I want to be in the 6K club, or I want to be in this club," right? And they're saying, NAV doesn't matter. Well, guys, if you get a 45% drop over the next year, mark my words, it's going to matter. It's going to matter a whole lot. How many people were in Tesla when it dropped? Okay, which was Tesla. It still hasn't recovered almost. It's like a break even with 26 payments. Okay, that's not a way to ensure yourself success. And it's come way back, right? I mean, when it went down to 100, well, it's in the twos now, 240 or something. What is that price of Tesla? 260 even, yeah. Okay, so nothing is cast in stone at these levels, guys. We have to always be watching the market because they're only as good as what they show you every day. I expect the VIX to top in, say, the third week of October, the week of October 21. So I'll be looking to take my profits because I think the market, if it comes down over those weeks and reaches that point, it could bounce again, right? So I'll probably sell a portion of those or a percentage of those. So that's just one strategy. All right, let's go over and let's talk about the Dow. Let me try and give you some setups. I have a number of psycho guys I follow, and I have been following over the last 20 years, and they've been pretty accurate in general. So I try to gauge what, and nobody has it dialed in perfectly. Okay, so here we are at 927 close on the Dow. I use Dow, but you can use the S&P and have very, other than the numbers being different, the percentages will be similar. Okay, so with the Dow, we're at 42,313 on 927. What do I think from cycle, guys? What are we very likely going to see futuristic in a Dow come 2032? Go 8 years out. I think 65,000 is a real solid, respectable number. But you have to understand what that means. Okay. So let's say, okay, that's 8 years. So that means it's going to go up $2,800, 2,836 points a year. What's that on an annual rate? If it's 53.62, I divide by 6. So every year you may get a 6% rise, okay, in the Dow. But you know what that's likely to look like? It could be 19% down in 2025 and up 24% in 2026, down 8%. Do you see what I mean? They're never going to be just repeatable numbers. They're going to be, that's what people don't understand. So if you have a year and you're out there and you get killed in the markets for a year, and you lose a lot of your principal, you've really hurt yourself. So just be careful how you bet, how you use leverage, how you use margin. There's not a quick fix to all these kinds of things. And understand that sectors and cycles shift. I've talked to some of you guys before about how I retired it in the decade. I used the decade of 2000 to 2010 to basically build my retirement. The company, I was with a big tech company, and they were laying people off, and things were turning down with the '08 Lehman Brothers. But I had just made, I had done 8 to 10x in that decade, just playing precious metals, gold, silver, the mining stocks, the futures markets. I just studied that like crazy. And it outperformed the SPX and the Dow like 4 times, 5 times. I got to where I almost didn't get back into the SPX in the following decade because I was so turned off. And sure enough, the cycle, though, the next decade was pretty darn good, right? So that's what happens. The cycles are always running. Even within tech, I could go in if AI is flying, and I could pick an AI stock that just got cut 50% in the last 6 months because its cycle is counter to the overall, sector. And I see it with occasionally with mining stocks, right? So don't just assume they're all going to be flyers, but your indexes and your averages do well. Okay. So let me take you. So all I wanted to say is be aware of this. So I'm not a bear out there, but that doesn't mean that we don't have the tail end of this year might be a 20% retracement in the Dow or the S&P. I don't know what it's going to be, and I'd have to then go do the math and say, what does that give us for the year? It probably gives us a fairly flat year. I don't know if we turn down. Let me pull up an S&P chart for the 1 year. Okay. So if we go back in December, we were a little below 4,600. January, we looked like we were 4,700. Okay. So if we went from, say, 5,800, if we get up to 58 and we pull back by the end of the year to 48, 47, that's 1,100 points. That's about a 20%. That's over a 20% decline, and it would make us break even. So you fit my example. I'm saying 8 years out, we only average 6.7% up in the S&P 500. So don't expect that, if you have a 35% year, 1 year, you're probably going to have a bigger percent down on the remaining 7 years. So it just doesn't work. Now, historically, if you went in and said, what does the S&P go up every year on average over the last 100 years? It's probably 8%, right? So what I'm showing you is it's going to underperform. And it could do worse. It could only be up 4% on average. Again, I'm just using somebody's cycle work that I subscribe to and I enjoy. So I can't put all their charts and data up here. It's not, I'm not able to do that in a commercial way. I can, use it for my own purposes, but I can't share it in a YouTube video. I can give you bits and pieces and talk to some of it, but I can't be more specific and do copyright infringement on things. Okay, guys. So here's something else I want to talk about. So look at NVIDIA. Oh, here I am saying the Yomax fund NVIDIA. I mean NVIDIA. Okay. I've tried to warn you guys. I've had people ask me to cover NVIDIA and this and that, and I'm kind of done for the most part with Yeomax. I'm still gonna cover Tesla. I'm gonna do some on Coney and Misty. Probably won't do in NVIDIA uh, because I'm going to be shorting the stock. Look at this chart. Now, again, this doesn't mean this guy's correct. I got somebody's stuff out on X. I've looked at it, but I've done all kinds of other analysis myself on NVIDIA, and I see it in a bearish position. Okay. Look at this thing. So here we are. I can't tell which one of these are October 1, but I think it's possible. Okay, where are we on NVIDIA? I think we're at 121. Let me pull it up on a chart. So we're at 121.40, the close on Friday the 27th. I think it's possible we could get to 131, 134 at probably the utmost, but I would be shorting it like crazy if we got to 131 and even a little higher. I would start shorting at 131, and if it doesn't get there and I see the markets are starting down, I'll go ahead and short it at whatever level it's at. Now, now I know what somebody's going to say to me. Well, Bruce, there's dips. Why don't you just go buy dips? Guys, same old thing. I don't trust Yeomax. Yeomax doesn't trust Yeomax, okay? Jay and the boys aren't getting the job done if you haven't noticed. Okay. Yeah, they got spreads, but you know what? Their spreads are typically 10 points. Oh, well, that's where we can get the best deal. Best deal for who? They're always going to focus on income. When you focus on income rather than return, like you would treat a growth stock, you've lost the battle and you're in the process of losing the war. So I don't see it, people. It doesn't mean you can't buy dips and it doesn't go up and all that. But take this scenario. I have no idea if this is going to pan out exactly. Would I go out and bet hundreds of thousands of dollars or 15, 20% of my portfolio? Of course not. But would I go out here and buy an ETF that's 2x bear? Absolutely. And most any ETF that's truly going to leverage it 2x isn't even going to pay any income. I don't care about income if I really want to make the large percentage, but the problem is I limit myself in time. I got to go out and buy the puts. Well, the puts are pretty expensive, right? But I could quadruple 6x, 10x my money if this thing moves. If I go out and buy a 121.40 put, for instance, and I go out to November, I don't know what I'd have to pay for it, but it would be expensive, you know. But could I make, if this thing went to just say 70? Well, let's say I bought it and I could be looking at the option charts. I'm not. It's a weekend. I don't have it all up. But let's say that that put was 12, cost me $12 for third Friday in November. Okay. And let's say that the stock goes to, let's make it even 80. And I bought the 121 put right at the market. Let's say it doesn't go up any higher. And I pay $12 for it. Okay. Well, if it goes to 80, that's $40, right? Right there. $41.40 below. Well, let's say I bought a 121. So it's $41 and I paid $12 for it. Okay. 3.5x my money. But my point is on these ETFs, I can go find one. I don't have them all in front of me. I got a big list of leverage ETFs, right? But I'm sure a lot of you guys that trade the ETFs, right? You'll have them in NVDX, NVD, what all the symbols are. Let me try NVD. That seems to strike a bell here. That is 2x short. Yeah, okay. So that stock is trading at $1.72. So I imagine if I go back and look and I say, well, last time it was $10 was February, right? What was Nvidia trading at in February? Pretty cheap. So in February, I'm seeing between 60 and 75. So if I look at that alone, now that doesn't always exactly correlate, people, but it gives you an idea, okay, of that kind of a number. So I could get a 5x in something like that. So all I'm saying is these things will move because they're leveraged. They're not something to hold for 6 months. That leverage will kill you. It'll decay. But way better than potentially getting capped, and whether they put the spread on or they didn't, or the spread had too big a gap. And I just I I can understand where a stock or BTC or something is going, but I'm kind of done with Jay and team. I just don't think they're getting it done. I like Roundhill a lot better. I like what they're doing. But even going forward beyond that, I'll report on all that stuff for the next 6 months or a year. But I'm going to start moving into the commodity mix. I think a lot of you guys know I had a lot of love for that. So why commodities? I expect commodities, metals, precious metals, miners, agriculture, and energy, just to name a few, to massively outperform over the next 8 years. So let me give you, for instance, if I think they're going to go up, let's just say precious metals, 400 to 800%, okay, which is a 4x or an 8x, okay? What did we say we were going to do in 8 years in the S&P? So the S&P is going up 54%, and that gives us, how about PMs? Let's be conservative and say that they go up 500%. Well, that's a 10x. So if I get the right basket of PMs over the next 8 years, I should be averaging, let me do the math, 40% a year versus 6.7, right? I'm just doing this in my head while we're talking. I think I got the math right. 40%. So you guys get where I'm coming from. So just take that as a yield. Now, if you get in the right indexes, these things are paying a yield. Right now, that yield isn't a lot. Go out and look at GDX, for instance. Probably yielding what? 1.24. That thing could get up to where it's yielding 6%, 8%, and it's significantly higher than it is. So its yield is based on it. So if GDX is 150, right, on its way to 400, or okay, 5 times, let's say it's going to 200, but it gets up to 100 and it's yielding 5%, that's a lot. So I just can beat Yield Max, because they haven't shown me on a simple fund like GDX. Look at the chart. It's done almost nothing but move up, and Yield Max isn't even back to even with their NAV. I mean, they just horribly, I say they mismanagement. Part of it is even the market doesn't have the volatility priced correctly. So when they write these calls, they can't get any money. And then they turn around and they write them even shorter to try and get income because the, what's the word I'm looking for? Volatility, because the implied volatility, the IV is so low, they write them in tighter, and when they sell them to get more, and guys, they get capped and then they take a big loss and it just drops the fund down. I'm just so sick of the poor management, poor execution, not understanding the sector. They can talk about spreads all they want, but the proof's in the pudding. So anyway, that's my. Hopefully, you don't see this as a rant. It's not anti yield max as much as it is. There's just better ways to make money going forward, guys. A lot better ways to make it. So I can swing trade these things. I can sell calls if I want to. If I get in GDX and I see where it's going to go down, then I can go out and I can sell some long dated calls. And if it drops down 20%, which is what these things do. I mean, if GDX is going to go to 200 by 2032, then it's probably going to go to 70 or 80, and it's probably going to come back to 50 or 60, and then it's going to go to 100, and it's going to come back to 70. So if you play some of those things and it's hit a high water mark, go out 3-4 months and write a bunch of calls, covered calls if you own the underlying, and just collect your money. So there's just so many better ways to play this. Let me wrap this up for you guys. So here we are, S&PX up 54% over the next 8 years, my 6.7, guys. PM's up 400 to 600. I'll give you guys details on what I'm buying, what you should buy. Silver and platinum will greatly outperform gold. Whoops, outperform. I'm Okay, guys, I'm almost done. Gold is 7,500 to 10,000. This thing could go to 20,000. You don't want to be in a world with 20,000 gold. That means where nukes are flying and EMPs, and you really don't want to see that because it's pretty destructive. But I don't see any way out of 7,500 to 10,000. Well, when it's that kind of price, these miners are going to be printing money. Silver to 300. I don't see any way we don't get to 300. If you haven't looked, silver is like $31. It hasn't even got to its 1980 high of 50. Well, it did in 2011. And so one of the things is you start when silver starts making its run, it's usually near the tail end. Like if gold's going to run to 3,500 next year, when you see silver run up and let's say it goes to 60, it's a late bloomer and it just runs. That almost tells you we're about done with that particular wave up, right? Now you got to go through a 6-month retrace or whatever on gold and silver and the precious metal miners. But these silver miners, if you see silver at $60, these things will be up 4 and 5 times. Okay, so do the math from today's value of 2650 in gold, give or take 3150. Look at 10,000. Look at 31.5, and then understand that those are the metals, right? So if the metals are going to go up percentage, so gold's going to go up 400%. Okay, from not quite, probably 350, right? From 2,600 to 10,000. But the PMs typically perform 2 to 3.5 times what the underlying metal does. When they're in favor and you're truly in a market, not right now. We've seen the opposite. That's why the precious metal miners are so undervalued, because it's all been about AI and FOMO and even Bitcoin to a certain degree. And I'm very bullish on Bitcoin. I think Bitcoin's got a 20-year horizon. It's truly energy, money, digital gold. Think of it like ATM 30 years ago, when your mother or father or grandfather, whatever age you were. I remember the old people didn't want to have anything to do. Oh, that newfangled thing, you mean that plastic card? That's not money. Well, guys, you use it to get money. And so Bitcoin will be digital money. I mean, it is in some ways. It's just not readily adopted and is not completely out there. But it will be. It'll probably be $1 million plus a coin. So I don't think it's fake. I don't think it's a scam. I don't, but a lot of the other trying to figure out, is it Cardano? Is it Solana? Is it this? Is it that? I don't play that game. It's just not me. I understand some people do. And in sympathy of BTC runs, some of that ecosphere runs. But I don't study it like I do the other ecospheres to know what's going to do all that well. So I'm not knocking it for you guys that like it, but I am telling you I like BTC and Michael Saylor, and I like MSTR. So anyway, that's what I got. So this is going to be exciting, going to be a lot of fun. Hit me up with questions. I know I'll get a ton of them. I just can't tell exactly what October is going to do, but if you press me, we're going to sell off. Probably starting this week. The best case scenario for the bulls is we run up another week or two and then start down. But I think if we do that, we go down harder. It's just hard to know, but I don't want to own much. I'm 80% cash right now, other than my UVIX. I got a few miners that I'm just going to hang on to, because look, if we do go down 45% in the next 13 months, during that periods of the big drawdown, it's going to pull most everything down with it. Okay, it's not like there's immunity for metals and miners and energy and that kind of stuff. All right, guys, that's what I got for you. Sorry I'm so long in the tooth on that, but I figure you got a better chance over the weekend to watch it. All right, this is Bruce with Targeted Wealth Creation signing out. I'm not a financial advisor. This is not financial advice. Have a great weekend. Bye for now.